Welcome to Talk Shop, a commercial real estate finance podcast sponsored by Clear Market. Each episode, we'll bring you real conversations with industry professionals and talk about how deals are getting capitalized with bridge, construction, and equity financing. Our guest today is Scott Taylor, founding principal at Artez Capital, a debt fund focused on stretch senior construction lending and bridge financing as well. Prior to founding Artez, Scott served as managing director at Partners Capital Solutions, and he managed a portfolio of loans at Wells Fargo before that. He holds a finance degree from Cal Poly San Luis Obispo, and we're honored to have him on today. Scott, thanks for coming on. Excited to get into Artez and what you're doing there, but first, let's kind of kick it off with your background. You know, where are you from? Where did you go to school? How'd you get into real estate?
Sure. Well, first of all, thanks for the invite. Glad to be part of this. So my background, as you said earlier, I went to Cal Poly, studied finance there, and had an opportunity to do an internship at a local bank in between my junior and senior year, which really just kind of opened my eyes into, I found a passion in my life very early. And this was a heavy real estate lending bank, as most community banks are, and quickly just fell in love with real estate in general, and being a lender and meeting the developers and investors and understanding their different strategies and realizing that, every property is different. And, the fundamentals of real estate, it's not rocket science, right? It's not these biology or chemistry or, engineering guys that, and Cal Poly is a huge engineering school. And what I realized was kind of banking and real estate finance it's more of an art than a science. And that's something that I loved about it, is that you could underwrite, 2 apartment buildings and they could be completely different because of location and different types of, specs of the building. And that was exciting to me. Thinking that every single day when I go to work, there's going to be new challenges and it won't be like yesterday. And that's something that, has always been important to me. So I graduated, I ended up working for the bank. I moved to Santa Barbara and was a relationship manager, very young in my career. I think I was 21 years old at the time, and have just had incredible mentors throughout my entire career of people that I think saw talent, but obviously I was very green. I had no idea what I was doing, and a lot of, folks along the way really kind of brought me under their wing and helped teach me the business and help me understand how to be a great banker and how to be, manage risk appropriately and underwrite deals and all the things that come along with the lending side of the business. In 2006, I was recruited to Wells Fargo. I moved down to the LA area and spent just about 11 years at Wells. Really enjoyed it. Had the opportunity to, continue to climb the corporate ladder and take on more and more responsibilities. By the end of my career, I was managing, a very large portfolio of some of the biggest names in the space, including CB Richard Ellis and some of the other very wealthy families in the LA area. And I loved it. At the time, this was obviously prior to all the stuff that's going on with Wells now, which is kind of sad, all the scandals that are going on. But Wells was the largest real estate lender in the nation. And we had, it was probably 20 to 25 different groups within the bank that could do some form of real estate lending, whether it was CMBS, agency deals, life insurance company. Obviously we had the balance sheet that we could do loans ourselves, SBA, all the different kind of things that Wells did. And I found that I could really serve my clients through multiple products, not just what I personally could do. And so I really kind of became a student of real estate lending in general, not just, on a specific product that maybe my group did. I did a lot of construction. I did a lot of kind of value add type projects and really focused on repeat developers and repeat investors. And I quickly found that if you took care of these sponsors and you gave them great service, and you got back to them quickly. And when it was a no, you gave them a quick no, and you just did all the things to really build the relationship. These people would come back over and over and over, and they never shopped us, and we were always fair. We weren't, looking to do anything that wasn't within the market. But I wasn't being shopped. I wasn't. You could actually focus on adding value to the client versus spending so much time looking through deals that you never win. And so from a very young age, I realized how valuable the relationship side of the business is, especially in real estate. It's a very small community. Everybody knows everybody. And if you do something that, if you screw somebody over or do something that, maybe is questionable on the ethics side, everybody knows about it. And when you work hard and you provide great service, and you're truly there for your clients and you understand their business model and help them execute, they're loyal forever. And so, when I look back I've now been in this space for, almost 20 years now. And I think about the people I'm still working with today that I met, 15 plus years ago. And that's kind of exciting and kind of goes into, what we're doing here at Artez. So in 2016, I kind of thought I was going to be a Wells lifer. Honestly, I loved it there. I was, put in a position where I could, challenge myself every day. I had a great team. I had a great book of business and I loved it. But I got a call from a family out here in Calabasas that owns and operates Partners Capital Solutions. And they were looking for a fund manager. And at the time I was 33 years old and never thought I would have an opportunity at such a young age to do something so exciting. And I actually sat down with my mentors at Wells and kind of said, hey, if your son had this opportunity, what would you tell him to do? And I think begrudgingly, they said what an amazing opportunity and we're going to miss you here, but I think you should take it. And, it speaks to some of the mentors that I've had in my life that gave me good life advice, not necessarily what was good for them personally. And so that's something that's been, pretty special in my life. And so in 2016, I went to PCS. The prior management group had recently left to go start a venture on their own. And so it was, kind of getting into the business, figuring out what needed to be done, how to manage it, how to execute on the vision of the family. And we just had 4 incredible years in a row. We were able to triple the size of the fund. We did over $1 billion worth of deals. And once again, really trying to execute on the sponsor first repeat business model. That was something that, it definitely, as I learned more and more about the private space, I see folks that, I don't want to say are transactional, but a lot of their growth comes from, maybe folks that they haven't worked with before. And that's something that, I just didn't want to do. I wanted to really focus on, let's call it 50 investors and developers and get every one of their deals that we could do. And the ones that we couldn't, we're always trying to add value, introduce them to other folks in the space, both on the private lending and the traditional lending side, and act as a trusted advisor versus just a lender. And so we just did incredible things at PCS. We had a very, very talented team. The 2 guys that helped manage the fund with me, both Brian Stalker and Michael Jin, we executed a business plan that I think was hard to beat. And it's something that, I'm very proud of. And I think the family was very proud of. So when I first joined, as I said, I was 33 years old. I wasn't married. I didn't have kids. And throughout that 4-year tenure, I did get married. I had my first daughter, who's now, a little over 2 years old. I also have a 5-month-old at home, another daughter. And life had changed and scenarios had changed. And I felt that, at the time I was an employee. I felt that, I had earned the ability to potentially be a partner and not just an employee. And so I went to the family and asked if, am I a highly paid employee or am I a partner? And, they weren't looking for a partner. They had run the business the whole time, just owning, the management company themselves. And that's fair, right? I mean, the family was great to me. I still have great respect for them and what they've done. And we always saw eye to eye on things, but it was important to me to be an owner and a partner and an entrepreneur. And so, that was at the end of 2019, all pre-pandemic. None of us had any idea what was coming. And, March 2020 comes along and that was some tough times. We had to figure out how to run the entire business while everybody worked from home. We had to execute our business continuity plan, which, thank goodness we had done a great job at preparing for the worst. But, that was a scary time for lenders, for owners, for, really anybody in the real estate business and obviously lots of other industries. But, where we focused, it was, we re-underwrote every deal in our portfolio. We had over 100 loans at the time, over $300 million of commitments. But what we saw again, which proved really our business model, was we knew our sponsors, we knew our borrowers. We could pick up the phone and call them. We could go through worst case scenarios. We could restructure deals. We could, maybe take additional collateral. We could get a pay down. We could do a bunch of different things. There was, scenarios where we would give them a 6-month interest reserve to get them through kind of the black swan event. And even through the pandemic, we never lost a penny. We did over $1 billion. We never had a foreclosure. We never had a loss. We were able to return over 8% to our investors without using a lot of leverage on the fund. And, that's something I'm very proud of. The team really came together. The sponsors that we choose to do business with came together. We all were on the same team rowing to the finish line. And I'm very proud to say that, even to this day, and I'm not obviously at PCS anymore and managing the fund, but still to this day, they've got an impeccable track record and something that, I was involved in for a while, but it's a very talented group over there and executed a great strategy. So when the dust kind of settled a little bit after March, I went back to the family in May and just said, it's important to me to be an owner. And however, you guys have been great to me. Everything was always done as agreed and there were no issues there. And so I let them know that I wanted to go out and do my own thing, but I didn't want to put them in a bad position because of all the things that they had given to me. So they asked me to stick around for about 5 months. They hired a new fund manager. I worked with him daily to introduce him to investors, to the borrowers, kind of teach him the business model of what we had been executing on the last, 4+ years. And I officially left in October of 2020 and started Artes Capital. Brian Stalker and Mike Jin, who helped manage the fund with me over at PCS, also announced to the family that they were going to join me. They also, gave them 60 to 90 days to make sure that the transition went smooth. We wanted to make sure that, for everything that they had given us, that we didn't put them in a bad spot. And that was very important to us. It was important for our reputation in the marketplace to know that, for people that work with us to know that we're fair, we work hard, and if something comes up, things might change, but we're not going to put people in bad spots. So we started working on all the PPM and underlying docs and creating entities and doing all that stuff in October of last year. We officially launched our capital raise kind of in March, April of this year. We've had just incredible support from, folks that we've known in the space for many, many years. We've raised over $100 million of capital in our first quarter. And we also just had tremendous loan production. We closed over $80 million of loan commitments on 23 properties in our first 90 days. Something we're, extremely proud of, and, kind of goes back to our repeat business model where we believe in this space. Sponsors do business with people. They don't do business with, an entity. And so, a lot of relationships that we built, even from my Wells Fargo days and prior, a lot of those folks came to us and we did deals in our first quarter. So that's kind of where we're at today. It's been a heck of a ride. I've got 2 young girls at home, and so lots of things going on the personal side and very exciting things, going on the professional side too, even though it's a lot of work. This team wakes up every day and we love what we do. It's not work. We're adding value and serving our network. And that's something that, will always be a core focus of ours.
That's awesome. Congratulations on taking that step and starting this venture. And it seems like a whole new chapter in more ways than one. And, you touched on, a concept or an idea of being more than just a lender, and being a true partner and an advisor. And, I think there's a lot of, capital out there. It's a commodity right now. And being able to, advise and kind of give advice that is not always, what best serves yourself is I think that's what builds that trust over time. And it's I'm sure that you've seen your company grow with as your clients grow, right? You're helping them,
Absolutely.
Get into maybe bigger transactions and amass a bigger portfolio. So that's great. I want to jump into, your products that you're offering and kind of the credit box or investment criteria. Tell us about, what type of deals you're financing.
Sure. So one of our strategies on that is, as I'm sure you and your audience are very aware of, the amount of money coming into the private lending space over the last 10 years is just incredible. I remember in 2019, I literally felt like there was a new debt fund every week. And there was a big announcement, another $1 billion raised. It was just like, golly, this is crazy. And, so one of our strategies has always been, we want to be bigger than the syndicators that are kind of out there doing first trust deed lending and stuff like that, bringing in investors. Everybody's on the loan docs. It's kind of like herding cats and challenging, and for the folks that do it well, they've got it in place and they can execute very well. But we wanted to kind of be bigger than that, but smaller than the big institutional players because, at least what I found, especially when I was at Wells, when we were working with CBRE, for instance, they're grinding you on basis points, right? Because everybody wants to do $1 billion line of credit with them. And so it becomes more of a commodity. It makes it more and more challenging to truly add value outside of pricing. And so we didn't want to go up and play in that world either, because that's, we create value with our clients. We don't give them loans. And so when the loans that fit our box make sense for them, how do they put a price on what we do for them? It's, we're creating value, and we have to do that every single day. You don't just get a relationship and then go, oh, okay, now it's the relationship. No, you got to earn that first call every day. And that's something that we take a lot of pride in. But so typically our box is kind of $1 million to 15 million. We can go under that. We can go bigger than that, but I would say that's where we like to play. Our average loan is typically $3 to $5 million. And when we were running the old shop, we were doing over 100 deals a year. And we did $400 million of volume in 2019 with $1 million to $10 million loans. And so it's a very active fund. We typically close 10 plus deals a month. And, you know, we've got just a stellar team, the best people in the business, I think, that can execute on that well and make sure our clients are served. So one of the unique things about Artez too is we do both bridge and construction loans. There's a lot of groups out there that, you know, focus on one of those. You know, there's great private lenders that do bridge loans. There's great private lenders that do construction loans. But, you know, one of the things that I've actually found in this space, the more time I spend and the more, you know, fund managers and owners that I meet and we get to know each other is, yeah, we're competitors. We're all doing private real estate loans, but we all have our unique investment strategy. And, you know, none of us has unlimited capital. We don't have access to the Fed window. And so we actually find that, you know, I'm probably one of the biggest referral sources for them, and they're one of the biggest referral sources to me. You know, they know what Artez does. And when things hit their desk that don't fit their, you know, unique strategy, they want to take care of the client. So they refer them to people that they know and trust. So, you know, our strategy is very, as I said earlier, is very sponsor focused. Over 80% of our business is with the same guys every single year. And so what we look to do is we're, you know, very high touch, very high service, very high, you know, ability to structure loans that fit the client versus creating a box and trying to shove clients into those boxes. That's not something that, you know, we're interested in doing. The capital that we've raised is discretionary, so we can make the appropriate credit decisions and loan structures that actually fit what the client is looking for while we manage risk. So, you know, one of the other unique things about Artez is we typically get some form of guarantee from the sponsor on almost every one of our loans. That's very rare in private lending. You know, most of these deals are non-recourse with bad boy carve-outs and that kind of stuff. And so, you know, our sponsors understand that, you know, we might have flexibility on structure and stuff like that, but we're really looking for everybody's interest to be aligned. And, you know, they're committing to us that they're going to get the deal to the finish line, and we provide, you know, the majority of the capital to help them do that. So that's really our strategy. I mean, the stuff that we focus on is really the stuff that our sponsors focus on. So when we find business models that we really like and investment strategies we like, we capitalize them. So what our clients are doing today, we've got guys that do a lot of build to suit credit tenant retail stuff, Starbucks, 7-Elevens, Chick-fil-A's. We do a lot of that financing, and we love that space. Honestly, when I was at Wells loved that space too. We just couldn't execute quickly enough. And so, you know, we couldn't win that business on a regular basis just because we couldn't move fast enough. So here, obviously, we can execute very quickly. We can close deals in 2 weeks or less if we really need to, but, you know, like to focus on kind of a 2 to 3 week closing period. So we do a bunch of that business, and there's such an upside of value creation for these sponsors. They don't really care. I mean, they do, obviously, but it's more important to them to have certainty of execution, to close quickly, to fund draws quickly so they can get the project done and sell it, and or refinance it on the back end. So they don't really mind paying the higher rate in the interim while they're, you know, creating the value. We love entry-level housing. That's kind of been the darling of the pandemic. You know, housing prices has just continued, especially in the markets that we serve, where we know that there's housing demand. And we love the entry-level stuff. I mean, the stuff is just getting gobbled up. So we do a lot of that financing. We've got a couple guys that do industrial condos. And so we provide construction on that. You know, industrial has also been one of the, you know, strongest parts of the market. And so that served us very well. And then the last thing we do a lot of, even though it's very competitive, is multifamily, both ground up and rehab. You know, bridge for people to acquire stuff and you know, figure out a business plan that they want to execute, but they just want to close quickly. So that space is, I would say, much more impacted, and a lot of players play in that. But, we love multifamily and in the markets that we play in. And we've got sponsors that, continue to bring us deals versus really shopping us. So of the 23 properties we closed on, we probably only looked at 30 deals, and we closed 23 of them. So that's something that allows us to really spend time and energy on deals that we know are going to come to fruition versus, gosh, I recall even from my Wells days and talking to a lot of other groups out there, especially in the 20 plus million range, people are putting out 20 term sheets and winning one. That's a whole bunch of work on the front end to only get one deal out of that. And our real focus is if we can take care of that sponsor and do whatever they need to help add value to their operation, we're most likely going to win the deals that fit our credit appetite, and that allows us to spend quality time on deals that we know we're going to execute on. So that's kind of our strategy. And it's served us well. It's served us well throughout my entire career. And I've now gone through two, real estate dips where there was, significant pressure, both of them very different. But when your sponsor has, outside cash flow, liquidity, net worth and other things, you can find ways to get to the finish line. And when you're solely relying on the property, things can get pretty hairy. And luckily that hasn't been our strategy over the years. And just one more thing to comment on, we don't sell our loans, and we service them ourselves in-house. And so between, myself and my two other partners, we are the decision makers on all of our deals. So when somebody calls us, we can make a decision immediately if we have all the data and information that we need. And then they're not calling an 800 number. They're not working with some third party that knows nothing about them. They're working with us. And so that's another thing that's very valuable to these clients. And they're honestly willing to pay a slight premium over market for that. So that's part of our business strategy as well.
Nice. 30 term sheets to 23.
Not bad, huh?
Completely. That's a nice pull-through ratio.
Yes.
I'd like to drill down on that and what's the secret there? How do you prioritize deals as they come across your plate? And what kind of information is most critical in kind of making those decisions?
Yeah, I mean, it's sponsor first. So who's the sponsor? Are they experienced? We're not looking for the new investors, the new developers that haven't been through the ringer. It just, occasionally we'll do it here and there when it's all, everything else lines up. But, what's really important to us is none of us know when the next downturn is going to be. None of us can predict these black swan events. But if you're doing business with the right people, you at least have the best chance to protect yourself and your investment. And folks that are experienced in it and don't panic and have a network and have multiple different exit strategies fare much better than folks that don't. And they're just like, oh, we can make money in real estate, we're going to start doing it. Those both on the lending side and the equity side, the folks that are newer to the market and don't truly understand how to manage those difficult situations. And by the way, in our years, it's not like every deal just went perfect, but we were able to manage them through and get everybody to the finish line. And that's what's the most important. So it's really sponsor first. And then we know what fits our model and what doesn't. And so we can, within 10 minutes, we can look at something and know if it's a good fit or not. And if it's not a good fit, the first thing that we're doing is introducing them to a group that is a good fit, that we've got a relationship with. And so, I think our clients appreciate that. That's how we earn that first call. They know that we're not going to waste their time. Our network of folks, like yourself that bring us deals, they all know that we're not going to waste their time. And we're upfront and honest. And when we say we're going to do something, we execute on it. It's as simple as that. I mean, obviously there's deals where there's a surprise that happens, after you issue a term sheet, and things might change if you find out new information that you weren't aware of. But, we typically can look at the deal and make decisions very quickly. We're also not the jack of all trades. We don't try to be everything to everybody, but what we do very well. And so we don't get shopped. I mean, I don't know how else to explain it. It's weird. When I talk to everybody, they're like, well, what do you mean if you put out a term sheet, how do you win 75 to 80% of them? It's just, they're not going to anybody else. They're just saying, man, if you can do this deal, here it is. And so when we can do it, we execute on it. We close it in 2 to 3 weeks, and everybody moves on, and it's a good experience. I mean, our clients are probably our best marketing, because they go out and tell everybody they meet that it's just a different experience here, that this team works very, very hard, and we're experts at what we do. And so we can execute at a very high level that I think it's probably the thing I'm the most proud of here is that we're able to serve our clients and our investors, because I think we have the best team in the business. Obviously I'm biased, but I've been involved in a lot of different groups over my time and my career, and these are very special people. We all row in the same direction. We all have each other's back, and we try to create an environment where people want to be, not where they have to be. And because of that, we get the best talent in the space. So.
Great. Yeah, and probably a function of that balance sheet capital structure, which I'd like to, ask a little more. What led you to decide to be balance sheet? And I know you kind of touched on being in between the trustee guys and kind of the guys who are leveraging up and kind of going with the CLO model. Yep. Talk a little bit more about that, and then maybe we can talk about what's going on in the greater landscape and as far as consolidation and
Sure.
Things.
Yeah, I mean, what's important to us, and honestly, we named our company after it, right? We believe this is an art, it's not science. And so the more decision making and the more items that happen through a third party that are outside of your control, the harder it is to give the white glove service that we think we provide, and that that's really our end goal, is to provide the best service possible, because you can't put a price on service. So the reason we don't play way up here and kind of down here is it's harder to control those outside variables. When you raise institutional capital and you have the CLO model where you're packaging up deals and selling them out to the market, you don't have control when black swan events happen. And there were countless funds out there that when the pandemic struck, their capital dried up like that. I mean, they were out. And there might have been investors or other kind of groups that were able to come in and change the business's model because they had the ability to. And so what we went out to high net worth individuals, we went out to family offices and kind of wealth advisors, registered investment advisors, and put together our credit box and what we focus on, where 95% of all of our loans live. But we said, if it's within that box, the three partners who have years and years and years of experience of doing this stuff with an amazing track record, we've got discretion, and we can execute those deals and structures how we see fit. Now, if it's ever outside of that box, we have an advisory committee that we can go to and talk through deals where we still think it makes sense. But for the most part, 99% of all deals that we do, the three owners of the business get together, we look at it, and we make a decision, and we close it. So, I was at Wells, right? Largest real estate lender in the world. There's red tape everywhere. You've got to, it just the government, the credit approval process, the policy, the everything. And, there are scenarios that don't make sense for the policy because of whatever. And you need to be able to make really quick decisions based on your expertise and the actual scenario versus, policy. And so we're able to do that very, very well. But the larger you grow, could the three of us manage a multi-billion AUM portfolio with thousands and thousands of loans the same way that we manage Artez today? Probably not. So that's kind of why we like this sweet spot. It allows us to, bring all of our expertise and backgrounds and creativity to every single deal. And the sponsors love that touch, and that's why they work with us. And our investors love it too. We're able to give them we think a very appropriate risk return. And it's something that so far here we are 4 months into this thing, and kind of all of our vision and all of our the way that we wanted to build it, the market showing that there's appetite for it, both on the investor and borrower side, which has been exciting.
Yeah. I think, the investment itself, the bridge or construction loan secured by a hard asset is a pretty attractive risk adjusted return. Yep. And you really, your fund is structured around that. And it's got to be hard you can't compete on price with the funds that are out there, leveraging up and kind of selling off their loans. And, it's a whole different business model, but, and it takes a lot of discipline. So, good for you guys for finding that niche and sticking with it and executing well there. I want to jump to some deals. Let's talk about, let's talk about a war story. Is there a deal out there that, a transaction that didn't go as planned, or maybe something that you passed on that you're glad you did, or tell us a story about that?
There's a ton of deals where the deal looked good, but maybe the sponsor didn't have the background or the, whatever it was. And, we pass on those deals all the time. If the sponsor is not a fit, it doesn't matter what the property is. It's just not worth it. I've gone through too many kind of workout scenarios and, different kind of negotiations over my whole career where people pay you back, properties don't. And if the people aren't the right people, it's miserable and it sucks up all your time, and you're not able to focus on adding value to your great clients. And so, I'm sure there's been things over my career where we passed on a deal that maybe didn't go too well for whoever did finance it, based on maybe the sponsor wasn't the right fit. But, I'm pretty, knock on wood, I'm pretty lucky that, I've had a long career in this business. I've been truly in the relationship management, kind of credit underwriting my entire career. I started right out of college. I didn't kind of go through a program where I worked my way up as analyst and blah, blah, blah. I was very lucky to be in the role immediately. And so I've truly managed relationships and structured deals for almost 20 years now. And I've looked at tens of thousands of loans. So, the war stories we see out there, honestly, and we hate it when it happens to one of our sponsors, is they go down the path with another lender. And, we either maybe warned them about it and they didn't want to pay a premium or whatever it was, or maybe it truly was a bank type loan, traditional lender loan. And you get that phone call 2 weeks prior to either a 1031 hard date or an escrow where the seller realizes they sold it way under market and they're getting all these other offers. And so the seller's doing everything they can to cancel the escrow so they can sell it to somebody else. And, And the sponsor's in an absolute panic because whoever that other lender was left them at the altar for whatever reason, right? Maybe the sales guy represented that they could do something, but they didn't actually talk to their credit guys. Maybe it's just a timing thing. I mean, the most recent one that happened to us was a client of mine from Wells Fargo who buys a lot of kind of industrial and other kind of properties in the downtown area. Very wealthy group of investors, been doing it forever. I worked with them at Wells. I actually did some stuff with them at my prior shop too. And we got that call that we hate. It's like, I got to close in 8 days. I got this thing 25% under market. And my bank just told me they're going to need 3 to 4 more weeks. And the seller's doing everything they can to cancel escrow. So they put in half, we put in half. We obviously already knew them, so we already had that relationship. That was critical. We don't execute on something like that if we don't know the people. But due to their relationship with the Artez team, we were able to execute and save them. And so now the bank will close and pay us off. And unfortunately, they had to pay a much higher rate and fees than what the bank was offering them. But they also were going to lose the property if they didn't know us. And so those aren't the fire drills that anybody likes. I mean, but we are able to execute on that. And I think, another reason people do business with us is they know that maybe this one is the single. It's the easy one that, they could get done anywhere, but they do it with us because they know that we're going to step up down the road. If it is a little more complex, or if there is a black swan event, they know that they can trust us. And so on these short-term loans, it doesn't matter what you pay in interest and fees. If you're creating that much value, it's much more important that your capital providers understand your business plan and can execute your business plan, because that's where your biggest risk is from a sponsor, in my opinion. How many people got their loans frozen in this last pandemic and they got screwed? How many people in 2009 had to file Chapter 11 because their banks stopped funding? That's where people get screwed. So paying a little more in interest doesn't matter. Obviously, these are all short-term loans, not permanent stuff. But so that's our business plan, is to execute. We want to be the Porsche, not the Honda. And there's nothing wrong with a Honda. Gets you from A to B, and it's great. There's a great business plan around it. But you drive a Porsche and then you go drive a Honda and you're like, man, that Porsche was nice. And for people that can pay it and people that know that Porsche is going to help them execute their business plan better, they'll pay it. And that's who we are. We don't try to be anything else. We try to be the best in the business, execute our plan. And when deals don't fit, we just say no. It's okay. It's okay. So.
Yeah. Well, that's an example of, just you're thinking more like an equity partner than a lender who's trying to put something in a box. And, that kind of brings up something I always like to touch on is that dynamic between sponsor and lender. And, it probably comes up less so with you guys, but I'm sure it does. When you have a sponsor who's really confident in this business plan, and lenders are capped on their upside, right? It's you got to protect the downside.
Exactly.
So how do you deal with that dynamic? What helps you kind of bridge the gap there?
Great question, and it's something that we work with our sponsors with literally on every deal. One of the things that we are able to do is if the sponsor is looking for maybe some additional leverage or other kind of things that we're not comfortable doing in the fund, we do have a handful of investors that will come in and take that risk themselves personally outside of the fund. And we can structure that, kind of behind the scenes and make it really clean and easy to our clients. But honestly, we truly are advisors to these guys, and we give them our reasoning. Now, they don't have to fully agree with our maybe risk analysis or how we're looking at the deal, but they at least respect that we tell them why. And we I just got a call on Monday, a deal that was brought to me by a very well-known person here in the LA area. Um, and they brought a deal that they wanted us to look at. And I immediately said, guys, I'm seeing a big hole here. Have you thought about this? Like if this and this happen, you've got a big risk. And they walked away from the deal based on that because, we gave them good advice. So I didn't come in and say, oh, well, I'm only going to do a 50% loan on this. Mike and my partner and I gave them real feedback of like, guys, we think you're taking risk you shouldn't be taking. And so we have that dynamic between our 50 sponsors that we work with pretty regularly. So, it took years and years to build that trust and to build that relationship. But, these guys don't come to us for loans. They come to us for advice. And then when the loans can get structured and the pricing and all that stuff makes sense, then we execute on it. So we start with advice. We start with value. We don't start with a loan. And so that's how we try to drive those relationships. And by the way, in the pandemic, we had to make some hard calls, right? We had there weren't fun conversations that happened, but it was done with respect. It was done with full transparency, and they get it. These guys get it too. They're experts. They're not one-off folks that don't understand how this stuff works. So it helps with those conversations. They never take it as like an insult to their project or anything. They understand that if everything goes great, I get my interest in my principal. If everything goes great, you guys can go to the moon. And if something goes bad, I'm putting up 75+% of the total capital. So, folks that don't get that, folks that we can't have those conversations with, we just don't do business with. It's as simple as that.
Yeah, never a good idea to think that you're the smartest guy in the room and you're as you want to get as many eyes on that deal as you can, and
Yep.
it starts with when we get a deal, we underwrite it fully, and then we take it to market, and we get a bunch more eyes on it, and we track all that feedback, and
Yep.
all that at the end of the day just makes your deal a lot stronger and gives you that confidence to really move forward with it.
Absolutely. And that's the value. That is the true value that you bring to your clients, right? It's not necessarily just putting a couple term sheets in front of them. It's truly talking to folks in the industry that understand the product type, understand the location, understand the potential pitfalls, and can give you a warning. That stuff is priceless. You can't put a price on that stuff. And so, as long as we can execute that model, I don't have to compete on price. And by the way, I don't mean that as like we're charging some exorbitant rate, but it's like, how many deals are lenders out there? Okay, we'll come down 25 bips. Oh, well, now the other guy will. Okay, we'll come down another 10. I mean, we just don't play those games. We just make it fair and we execute. So we're not wasting our sponsors' time. They're not wasting our time. We both parties can focus on what drives revenue. And that's the value we bring. We don't waste people's time so they can focus on their next deal where they're going to make millions, not save 20 grand in interest. The people that understand that love working with us, and the people that don't, we tell them to go work with somebody else. It's all good.
Absolutely. Well, hey, let's wrap it up. Let's end on a high note. Tell us about your best deal. Give us a story of a transaction that was a real win.
Well, I definitely have a lot where I wish I was the owner, not the lender, right? We love to see our sponsors succeed. It's honestly why we're in the business, is to help them execute on their vision. And I'll be honest, I'm a very risk averse person just in general. And people give me a hard time all the time. They're like, man, you'd be a horrible equity guy. You just have like too many, concerns. But I think I'm a great lender because of that. And but two of them that kind of stick out. We've got guys that do these kind of credit tenant, 7-Eleven, Starbucks. Some guys go in and they buy the property with a couple years left on the lease. They tie it up in escrow, and then they can go back to that tenant that they have a relationship with and renegotiate a new 10 to 15-year lease while it's still in escrow, right? So they haven't even really taken any risk on the property yet. And there's been a couple scenarios where literally they've tripled the value of the property while it was in escrow with a credit tenant. They sell it within 30 to 60 days of closing to another 1031 buyer. And we're putting in 85 to maybe even 100% of the cost. So they're like, the return on investment for these guys is absolutely through the roof. And so those are the really cool ones. Now, obviously they're very hard to find because everyone's looking for those deals, but we've definitely done a couple loans where, you know, someone bought it for $3 to $5 million or $2 to $4 million and tripled the value. Those are very exciting deals to work on. And I'd say the other one that actually even surprised me, we had a client recently that bought a empty multifamily building that actually was foreclosed upon by the prior lender. And they bought it at a very, very low basis. But, you know, it had some issues. There definitely is a ton of rehab and different things that need to happen on it. It's a historic building, so there's different kind of approvals that you have to go through. And it was a heavy lift, but the basis that they got it on was just amazing. And so we ended up helping them buy the property. I want to say we put in about 80% of cost, and we took some other property as cross collateral to help, you know, secure our investors. And I don't think anyone saw what happened, you know, was coming, but there was a local guy going around and assembling kind of an entire block for a big project. And it happened to be this block. And so this thing is going to sell for like 3 times what they bought it for in less than a year. And it was just, it's one of those deals that no one saw. Like the brokers didn't know, the buyer didn't know, nobody saw it. Just every once in a while you see these really cool deals, and you're just super excited for your clients that, you know, had the capital, had the, you know, the nerves, everything else to put capital at risk. And when they hit grand slams, it's awesome to see.
Yeah. And that's one of those things that it only happens in real estate, right? I mean, that sort of thing where, yeah. Well, cool. Well, thank you for sharing. Thank you for coming on. It's been great, you know, having you, and we look forward to getting something done with you in the future. Before we jump, if anybody out there wants to get in touch, you know, a sponsor developer has a deal they'd like to run by you, how should they get in touch?
Have them call you, and then you can send them over our way. But if they want to call me directly, my cell's 805-234-7999, and my email is scott.taylor@artescapital.com. And, you know, once again, I mean, the thing that we pride ourselves on is really adding value and you know, telling people what we think immediately. And, you know, that means referring them to third parties all the time. So, you know, any way that we can help and create value for your best clients, you know, we're here to help.